Welcome to the deep dive. Today we're going to try something a bit different. We're digging into the world of long-term wealth, not through some textbook, but by actually looking at a real document.
Yeah, it's the 2015 annual letter from Giverny Capital Inc.
Exactly. And these guys, they have some, well, pretty unique ways of looking at building lasting value. Our goal here is really to pull out the key insights for you.
And what's really remarkable, I think, about this letter is it's so much more than just numbers. It's almost like a masterclass in patient investing,
No.
full of surprising little facts, and it connects things you might not expect, especially if you're trying to figure out how successful investors actually think, beyond the daily noise.
Okay, so let's start at the beginning then. Giverny Capital.
Yeah.
How did they get going?
Well, the founder's journey, it started quite a while back. He was really, really inspired by the big names.
Like Buffett, Graham,
Hmm.
those guys.
Exactly. Buffett, Benjamin Graham, Templeton, Philip Fisher, Peter Lynch, all of them. And he took that inspiration and actually started managing a family portfolio way back in 1993.
Ah, okay, so family money first.
Right. And then, after getting some really solid results for about 5 years, Giverny Capital Inc. officially launched in 1998.
Got it. And central to how they operate is this idea of partners, right?
Yes, absolutely central. They really live by this idea of being completely in the same boat with their clients.
What does that mean practically?
It means the founder manages client money using the exact same strategy, the exact same holdings as his own family's portfolio, which they call the Roshan Global Portfolio. It's a serious level of alignment. You don't see that everywhere.
No, you really don't. And that kind of partnership idea, it seems to come through in the annual letter itself too. It's not just a, dry report.
Not at all. Its real purpose, they say, is to transparently explain their whole long-term philosophy, why they pick the companies they do.
So clients really understand the process.
Exactly. They believe for clients to be true partners, they need to get it. It boils down to, treating others how you'd want to be treated. Very straightforward, really.
And they even extend that transparency to the cover of the letters.
Yeah, it's a nice touch. Since 2004, they've featured artwork from their own corporate collection.
Oh, interesting.
The 2015 letter, for example, has a detail from a piece by David Altmid called The Flux in the Puddle. And this artwork, it's traveled around Montreal, Denmark, and apparently it's going to be displayed for 10 years at the Musée National des Beaux-Arts du Québec.
Wow. So it hints at this idea of maybe art and long-term value kind of intersecting.
Perhaps, yeah. It adds a different dimension, doesn't it?
It does. Okay, speaking of value, let's get into the performance.
Yeah.
Because the numbers, well, they seem to back up the philosophy.
They certainly do. In 2015, the main Roshan Global Portfolio, it returned 20.2%.
Which was way ahead of their benchmark at 13.4%.
Right, so an outperformance of 6.8% for that year. Now, they're very transparent. They note that a big chunk of that, about 16.3 percentage points, actually came from the Canadian dollar moving against the U.S. dollar.
Currency effects. Important detail.
Very. But even so, you zoom out, and that 2015 performance looks even better. Since it started, back on July 1st, 1993, that Roshan Global Portfolio has compounded at 16.3% per year.
16.3% annually since 93.
Yeah, and their weighted benchmark over that same period, only 9.0%.
Wow. So that's an annualized outperformance of 7.3% for, over 2 decades?
Exactly. It really tells you something about sticking with a consistent approach, doesn't it?
Absolutely. And they have specific portfolios too, right? Like a U.S. one.
They do. The Roshan U.S. portfolio, which is all in U.S. dollars, it actually beat the S&P 500 for the 8th year in a row in 2015. It returned 1.7% versus the S&P's 1.4%.
Not huge numbers that year, but still ahead.
Still ahead. And then the Roshan Canada portfolio had just an exceptional year. It returned 16.0% when the S&P TS index was down 8.3%.
16 versus -8? That's massive. An outperformance of over 24%.
Huge. And, that kind of long-term success brings up something interesting about managing expectations. Giverny has this rule of 3.
Rule of 3, what's that?
They basically accept and tell their clients that they might underperform the index, say, 1 year out of every 3 on average.
Okay, setting expectations.
Exactly. And if you look at their U.S. portfolio's history over 22 years, it only lagged the S&P 500 in 6 of those years. That's about 27% of the time. So pretty much in line with their rule.
So it reinforces that patience is, it's part of the strategy. Short-term dips are expected.
Right. It's a feature, not a bug, as they say. And this patience, it's tied directly to the absolute core of their philosophy.
Which is?
Treating stocks like you actually own a piece of the business, fractional ownership in a real company.
So focusing on how the business is doing, not just the stock price ticker.
Precisely. Forget the day-to-day noise. Look at the intrinsic performance.
And how do they measure that? They mention owner's earnings.
Yeah, that's a concept championed by Buffett. Think of it like this. It's not just the profit number the company reports, it's the real cash profit the business generates after putting money back in to maintain its position, its competitive edge, plus any dividends paid out to you, the owner.
So the actual cash flow available to the owners.
Kind of. They admit it's approximately correct, which is a great phrase, but they believe being approximately correct about the business is way better than being precisely wrong by just chasing stock prices.
Okay, I like that. And does the data back this up?
Well, look at their 20-year numbers from 1996. The companies they owned, their intrinsic value grew by, get this, 1,102%.
1,100%.
Yep, that's about 13.2% per year. And here's the kicker. Their stock prices over that same 20 years rose 1,141%, about 13.4% annualized.
Wow, that's incredibly close. Business value growth and stock price growth, almost identical over 2 decades.
Right. Now, compare that to the S&P 500 over the same time. Its intrinsic value is up about 297%, so 7.1% a year. Stock price is up 380%, or 8.2% a year.
So a much bigger gap between business value and stock price for the index.
Exactly. Giverny's results really suggest that this similarity between their company's value growth and stock returns, it's not just luck. It validates their whole belief. Long term, the market figures it out. It reflects true business value. It just, takes time.
And that long-term view clearly shows up in how often they trade, or rather, how little they trade.
Oh, absolutely. Their portfolio turnover is incredibly low. In 2015, it was under 10%. Their average over several years is around 15%.
So what does that mean in terms of holding period?
It means they hold stocks for about 6-7 years on average.
6 to 7 years, when the typical investor holds for maybe, 6 months?
Something like that, yeah. So Giverny holds like 12 times longer. Plus, they run a pretty concentrated portfolio.
Meaning fewer stocks, bigger positions.
Right. Their top 15 holdings make up about 80% of their portfolio. And many of those they've held for over 7 years. Think Berkshire Hathaway for 15 years, Disney for 10, O'Reilly Automotive for 11 years. That's real conviction.
That kind of conviction must have been tested in 2015, though. That sounded like a pretty rough year for markets generally.
It was challenging, definitely. You had oil prices just collapsing, economies weakening around the world, and a really strong U.S. dollar.
Right, which hurts U.S. companies selling overseas.
Exactly. So profits for a lot of S&P 500 companies basically stalled out. And the Canadian market, as they mentioned, was knocked all the way back to where it was in 2007.
Ouch. So how did Giverny feel about that kind of environment?
Well, interestingly, they said they were actually satisfied.
Satisfied with stagnating markets.
Yeah, because their underlying companies, their intrinsic value, still grew by about 11% collectively. But the stocks only went up about 4%.
Ah, so the gap widened.
Right. Which to them just meant their companies became more undervalued than the year before. It's a perfect example of looking past the short-term market mood.
That's a different way to look at it.
Yeah.
They also had that situation with Precision Castparts being bought by Berkshire, right?
Yeah, an interesting one. As Berkshire shareholders, Giverny loved the deal. Great business, fair price.
But they also owned Precision Castparts directly.
Right. So now they had a hole in their portfolio, needing to replace this, as they called it, company of rare quality.
So what did they do? Scramble to find something new?
Nope. Very pragmatically, they just bought more shares of companies they already owned and liked, including buying more Berkshire Hathaway stock itself.
Huh. Okay. Makes sense. And this ties into their view on market volatility, doesn't it? They actually like it.
They welcome it. They don't see downturns as disasters. They see them as opportunities, a chance to buy more of the great companies they follow at better prices. They even say, we are all richer today because of past market corrections.
That's a powerful reframe. Thinking of corrections as making you richer eventually.
It's fundamental to their approach.
Okay, let's maybe touch on a few of the specific company stories they highlighted. Quick hits. Disney, for example.
Right, Disney. They'd held it for a decade. They specifically repurchased it in 2005, right when Bob Iger became CEO.
And Iger made some huge moves, didn't he? Pixar, Marvel.
Lucasfilm, Star Wars. Just massive strategic acquisitions. And think about the results. The Force Awakens hitting $1 billion in 12 days, the whole Frozen thing. Iger created, they estimate, over $100 billion in shareholder value.
Incredible. Okay, what about Dollarama?
Dollarama, they bought into that in 2010. They called it an act of faith in the founder, Larry Rossi.
Act of faith that paid off?
Big time. Impressive earnings growth, great stock performance. Then there's Visa.
Visa, right. What was the story there?
Opportunity knocking. Back in 2010, the stock took a 25% dive because of worries about something called the Durbin Amendment.
Market panic?
Pretty much. And Giverny stepped in, saw it as a chance to buy a fantastic business at a, quote, very compelling valuation. Again, using market overreaction to their advantage.
Okay, now for a more dramatic one. Valiant Pharmaceuticals.
Ah, yes. Valiant. Giverny owned it from 2011. They were initially drawn to the CEO, Michael Pearson, and his very unconventional strategy, basically growth through acquisition, not much traditional R&D.
Which worked for a while, right?
But it did. But then, late 2015, it all hit the fan. Political heat over drug pricing, attacks from short sellers, the CEO got sick. It was a perfect storm.
So what did Giverny do? They're long-term holders.
They made the difficult decision to sell. The risk profile just changed too dramatically, especially with updated earnings forecasts looking much worse.
Yeah.
It shows even long-term investors have to know when to cut bait if the facts change significantly.
Right. Risk management. And one more fast one. They sold that after 17 years.
17 years. It really makes you ask, what prompts selling after that long? The story involves Robert Kierlin, the CEO, Inc. magazine, called him the cheapest CEO in America.
Cheapest? How so?
Paid himself only $120,000 a year, even though he owned 12% of the company. And get this, when they wanted to do employee stock options, instead of issuing new shares and diluting everyone else, Kierlin gave his own shares for the options.
Oh, wow. The dedication. So why sell after all that?
It wasn't that Fastenal became a bad company. It was just that its amazing growth rate had slowed down, and the stock price seemed fair, maybe not a huge bargain anymore compared to other opportunities they saw. It's about optimizing the portfolio, always looking for the best relative value.
That makes sense. Okay, shifting gears slightly, Giverny has this tradition, right? The podium of errors.
Yes, I love this part. It's where they publicly dissect their mistakes to learn from them. It's incredibly transparent.
And they make a really key point. Errors of omission, the things you didn't buy, are often way more costly than errors of commission, the things you bought that went wrong.
Exactly. Because those missed opportunities, they never show up on your brokerage statement, do they? So they're easy to forget or ignore.
It really is rare transparency. You have to wonder, how often do we really analyze the opportunities we missed? Or maybe held on to something too long when something better came along?
It's a great discipline they model. Their candor really highlights that commitment to always be learning.
Okay, so let's go through the 2015 medalists for errors. Bronze medal.
Bronze goes to Amazon, a classic error of omission. They absolutely admired Jeff Bezos, called him one of the greatest businessmen in history, loved his strategy of just investing billions to build this massive economic moat.
They saw the potential.
Totally. They even crunched numbers, estimating it could earn $28 per share by 2020, justifying a $700 stock price back then.
So why didn't they buy?
They waited. They wanted a lower price, sticking to their discipline, but the stock just took off, jumping 92% in just over a year while they waited.
Ouch.
Yeah. It highlights that tension, doesn't it, between sticking to your rules and knowing when, maybe, you need to make what they called an act of faith.
Like they did with Dollarama. Okay, silver medal.
Silver goes to O'Reilly Automotive. This was an error of selling a winner too soon or trimming it back too much.
They owned it for a long time, right? Since 2004.
Yes, saw it go from $20 to $263. Amazing run, but along the way they kept trimming their position. Their excuse, as they put it, was the stock always seemed slightly expensive. So instead of being maybe 11 or 12% of their portfolio, it ended up being only 4%.
So they missed out on even bigger gains.
Right. It brings to mind those classic investing quotes like Philip Carrett's "Be quick to take losses and reluctant to take profits," or Peter Lynch's "Don't pull out the flowers to water the weeds." They were watering the weeds a bit, maybe.
Okay, and the gold medal for errors in 2015.
Gold goes to Stella Jones, another painful omission. They found this Canadian company back in 2008, leader in pressure-treated wood products.
And it looked cheap.
Very cheap. The PE ratio was around 12 or 13, then even dipped to just 6 times earnings, and earnings per share were climbing steadily.
So why the hesitation?
Fear. They worried it was too cyclical a business tied to housing or railroads, maybe. They kept waiting for an even lower price, just in case.
And the stock.
It just soared.
Yeah.
Went from the $3.50 price they missed all the way up to $45, while the earnings per share quadrupled. Yeah. They even mentioned an article about the CEO, Brian McManus, and his super lean operation, only 14 people at headquarters running 19 plants. They recognized the quality, the efficiency, but that fear of cyclicality held them back.
So 3 really different kinds of errors.
Yeah.
Fascinating. Now, there's this other concept they bring up that sounds really intriguing, the financial Maginot Line.
Ah, yes. This is a brilliant analogy, I think.
Okay, so explain it. The historical Maginot Line.
Right. History lesson first. After World War I, France built this massive, incredibly expensive line of fixed fortifications along its border with Germany. Concrete bunkers, tunnels, the works. The idea was to prevent another German invasion, like in WWI.
But it didn't work in World War II, did it?
Not really, because technology changed. The Germans, with tanks and especially airplanes, basically just went around it or flew over it in 1940. The static defense was useless against a more dynamic attack.
Okay, so how does that apply to finance?
Well, what Giverny finds fascinating is how we do the same thing in the financial world. After every crisis, what happens?
We try to prevent that crisis from happening again.
Exactly. We build regulatory fortifications, often complex rules designed to stop the last war. We're always preparing for the previous battle, not necessarily the next one.
Can you give an example?
Sure. They mentioned the circuit breakers put in after the 1987 crash. Did they stop the dot-com bubble bursting? Or the 2008-09 crisis? Not really.
Or the heavy regulations on the too-big-to-fail banks after 2008.
Right. Necessary, maybe, but Giverny points out they also tied up billions that could have gone into economic growth. The point is, we keep building defenses against the last threat.
And Giverny's argument is that maybe the fundamental driver of crises isn't something you can regulate away.
Pretty much. They argue that the manic depressive behavior of stock market investors is immutable. It's just human nature, fear, and greed cycles, and no rule is going to change basic human psychology.
So trying to regulate it away is like building a Maginot Line against human emotion.
Kind of, yeah. And this applies to individual investors, too, they say. We build our own financial Maginot Lines. Well, if you got really burned in, say, 2008-09, you might be traumatized. So every time the market dips now, you see 2008 all over again.
You freeze up or sell everything, defending against the last war.
Exactly. And you end up missing huge opportunities when stocks actually become really attractive because of the correction. You're stuck fighting the previous battle.
Okay, that makes sense. And this leads them to question traditional safe assets, right, like bonds.
Yes, this is where it gets really provocative. They ask, is safety at all costs truly safe? Especially with interest rates being so low, often below inflation.
So buying bonds could mean you're locking in a loss of purchasing power.
That's their argument. They say ultra-low rates on bonds lead to guaranteed impoverishment, and they state it really boldly. The certainty of capital loss in purchasing power is the very definition of risk.
Wow, that flips the whole idea of bonds as the risk-free asset on its head.
It really challenges conventional thinking, and they back it up with numbers. Okay, imagine you buy a 10-year U.S. Treasury note yielding, say, 1.75%. If interest rates just go up to a more normal 5%, that bond could lose a quarter of its market value.
25% loss on a safe bond.
Potentially, yeah, in market value terms. Or a 30-year bond yielding 2.5%. If rates rise to 5%, it could lose 38% of its market value.
That's significant risk, not exactly the safety people expect.
Right. So their conclusion is that this fortified portfolio of long-term bonds might not actually deliver the protection people think it will. It might be an illusion of safety.
So if bonds are potentially risky in that environment, what about stocks?
Well, they argue that stocks, even with average PE ratios around 15 or 16 times earnings back then, already reflected an expectation of long-term interest rates being much higher, maybe around 6.5%.
Ah, so the valuation of stocks already priced in higher rates to some extent.
That's the idea, which, if true, makes stocks look potentially quite attractive compared to those low-yielding bonds. There's a big disparity in the implied future returns. It really makes you think about where the real risk is hiding.
Okay, so bringing this all together then, what's the main takeaway for someone listening?
Well, I think Giverny's letter, this whole deep dive, it's just a powerful reminder, isn't it? Markets go up, markets go down, there's always noise.
But the focus should stay on
Owning pieces of truly exceptional companies, businesses led by great people, and crucially, buying them at reasonable prices. It really comes down to patience and conviction in the businesses themselves.
And maybe rethinking where the real risks lie.
Exactly. This whole discussion suggests that maybe real success isn't about avoiding all risk. It's about understanding where the genuine risks are. Is it building that Maginot Line based on yesterday's fears? Is it assuming safety in assets like bonds just because they've been safe historically?
So the final question for you, the listener, to really think about is,
How can you better align your own investment strategy with the actual underlying value of businesses? Rather than getting caught up in the market's emotions, the headlines, the short-term swings, how do you focus on the business, not just the ticker?